The Big Short is a widely acclaimed film in the world of investing. It tells the gripping true stories of people who made huge bets against the housing market, earning billions just before the 2008 real estate crisis. While it highlights the potential riches in short selling, it also exposes the intricacies and risks of this trading strategy. In this comprehensive guide, we'll explore how short selling works, its mechanics, and the challenges it brings. The art of short selling. Short selling, often called shorting, is a strategy where you sell a security, aiming to buy it back at a lower price in the future. Unlike traditional investing, which is about buying low and selling high, shorting flips this, capitalizing on falling asset prices. In The Big Short, short positions are made through complex financial instruments, but for regular investors, it usually involves individual stocks, making it more accessible but riskier. The mechanics of shorting. Let's follow a simple scenario to understand how shorting works. Two investors, A and B, take opposing positions in a company. Plain Bagel Co., whose stock is priced at $10 per share. Investor A buys 1,000 shares, investing $10,000, while Investor B chooses to short 1,000 shares. Investor B doesn't actually own the shares they're selling. They borrow them from a broker. After selling, they have to buy them back, known as covering the short, and return them to the original owner, keeping any remaining proceeds as profit. If the stock price drops, Investor A loses money, but Investor B gains. If the price rises, it's the other way around. Investor B needs to post an initial margin, typically 50% of the position's value, as collateral to cover potential losses. This means they initially provide $5,000 of their own funds to account for price fluctuations. Leverage and margin. Short selling is closely tied to margin accounts, which provide leverage, amplifying both gains and losses. In our example, Investor B returns are boosted due to this leverage, but it also magnifies losses. If a stock's value drops, Investor A faces a 50% loss, while Investor B gains 100% due to leverage. However, losses are twice as large in a short position compared to a long one, emphasizing the risks. Costs of shorting. Short positions come with unique costs that long investors don't encounter. These include paying dividends and interest charges. When shorting a stock, you have to pay any dividends it distributes, potentially eroding profits. You also pay interest on the borrowed stock, similar to repaying a loan. Interest rates on short positions range from 2.5% to 20%, with higher rates for challenging stock. Risks and drawbacks. Shorting requires significant risks and drawbacks, such as the buy-in risk. Brokers may require you to cover your short position early, possibly leading to losses if they need to return the borrowed stock to its owner or if there's a surge in demand. There's also the short squeeze risk when heavily shorted stocks experience a sudden price surge, making it tough to exit the short position without losses. The most significant risk is the skewed payoff, where short sellers can theoretically face unlimited losses if a stock's price rises significantly. Short selling is a vital part of investing, offering a way to profit from falling asset prices. However, it's complex, costly, and risky, demanding careful consideration. The Big Short may glamorize it, but it's not for the faint-hearted and requires expertise, caution, and a deep understanding of the market.